Friends, welcome back to Accounting, ACCT1006. Once again, here on campus, here at the Law Library. If you could look out and you can see the Law Library. We are going to be reviewing week five's content, going over perpetual inventory systems. And some concepts surrounding GST clearings. This content will be testable in the mid-semester exam. As mid-semester, we're doing week 1 to 5, and then I would also be doing a separate review video for the mid-semester preparations. Mid-semester exam is coming up in Saturday of week 5. So today we're talking about the perpetual inventory systems. Quite a few things to take note of, perpetual, and let's just get right into it. So let me minimize my camera, and then we could get into our notes. This is because of chapter 4 of your textbook, Financial Accounting, Reporting, Analysis, and Decision Making. And here are the learning objectives for merchandising operations, which is basically talking about inventories. So first of all, identify the difference between service business and merchandising business. You should know this by since Buzz 1030 explained the recording process under a perpetual inventory system. So when it comes to inventory, there are two types of systems and methodologies that could be used. There's the perpetual inventory system and there's the periodic. Under a perpetual inventory system, you know how much inventory is on hand at all times. Whereas in a periodic inventory system, you do a stock take at the beginning and a stock at the end of the period, and then you can know how much inventory was used up. We're going to talk about perpetual inventory system first, since this is perhaps more straightforward. And then there are different quirks associated with perpetual inventory systems, such as learning objective 3, we have to explain the recording of sales revenue under a perpetual inventory system. So there are two entries, journal entries that we have to make when we do a sale with inventory. We have to decrease the inventory, and then we have to record accounts receivable being received and inventory going down, as well as the cost of inventory and the cost of goods sold. So there's two different entries, journal entries that you have to do when you do sales of inventory. Then prepare a classified statement of profit and loss, ratio analysis to talk about profitability, how effective is the company at getting accounts receivables, how effective is the company having inventory turnover, understand the basic process of GST, and complete journal entries of general sales tax. So this material, week 5's material, is testable under the mid-semester exam. Okay. So let's get into the notes really quick. So these are just some housekeeping. Once again, the mid-semester exam is 10th September. It's a Saturday, 90 minutes. So this isn't as important. I'm going to do a review video going over the mid-semester questions, going over some preparations for the mid-semester exams. So that would be a separate video to this. Week 5's learning objectives, we went over that. So why is merchandising important? I feel like you don't really need to know that. What is the difference between service business and merchandising? You should know that by now. Okay, let me just go through an example. Okay, so before we get through an example, let me just do a very broad overview. When we do a perpetual inventory system, we want to know how much inventory is at hand at all times. There are many reasons why we want to do that. We want to have better internal controls, have better understanding of the operations of the business, better identify busy and less busy seasons within the period, within the quarter, for example. So let's just see. Let's just go through this example right here. Work through the lecture example with me for these June transactions. June 5th, Jerry's Glorious Goods purchase inventory from Lean's Electronic Supplies, or 7,600. June, Gary Glorious Goods supplies bought freight charges, and on June 8th we have Jerry's Glorious Goods returning the goods sold to Eileen's Electronic Supplies. 12th of June, Jerry Glorious Goods has accounts outstanding and it pays to the supplies. And June 5th, trade discount of 10% to Jerry's Glorious Goods. Okay, so here we can see how we actually record inventories under the perpetual system. So 5th of June, what happened? So 5th of June, we have Jerry Glorious Good purchase inventory from Aline's Electronic Supplies for 7,600. Okay, if not otherwise stated, we assume purchases to be done on accounts payable, to be done on credit, rather than on cash. So we have inventories increase. So this is journalized June transaction for Jerry. Okay, so Jerry bought from Aline, which means Jerry's inventory goes up. Debit goes up an asset account for inventory. So debit, so 7,600, and accounts payable credited by 7,600. And once again, don't forget your notes. Purchase inventory from Aline Electronics. This is so straightforward so far. Second, we see 6th of June, Jerry's Glorious Goods pays We Deliver Freight Company 350 for freight charges. Okay, so if you purchase inventory, it doesn't just magically teleport to your inventory warehouse. You have to pay freight or transportation costs. So since Jerry is the one that is paying instead of Aileen, in this case, Jerry has to pay debit of 350 and cash of 350. Okay. 8th of June, Jerry Glorious Goods returns goods costing 600 to Eileen Electronic Supply. So supplies or inventory decreases, so therefore inventory decreases by 600, and account payable decreases by 600. Therefore, we debit account payable and credit inventory. Was number 12. Or 12th of June, Jerry's Glorious Goods settles accounts outstanding 7,000 and receives 2% discount. Remember the terms of discount. 2% within 14 days or 2% within how many days. Otherwise, this is the amount that you have to pay, right? So 2% received, so that is 1% will be 70, so 2% will be 140, and then there we go. We pay accounts payable, so account payable is debited. Cash goes down because we have to pay accounts payable, but then we don't pay 700. We only pay 6,800. 60 because 140 is discount received. So that is an income. That's an other income for Jerry. And after all these journals, we have the resulting inventory of this and accounts payable of this to record purchase of trade discounts. Okay, so we could see the purchase of inventory from the perspective of a buyer, from the perspective of Jerry. We may also be interested in the recording process of the sale of inventory from the perspective of Eileen or of Eileen. So once again, 5th of June, from the perspective of electronic supplies now, from Eileen's Electronic Supply, we have the sale of 7,600 to Jerry. So what we see right here is accounts receivable goes up, which is an asset account, so we debit it by 7,600, and inventory goes down by 7,600. Now, under the perpetual accounting system, we want to know how much inventory we have on hand at all times. This is why we have another column here called cost of sales. Cost of sales is how much you purchase these inventory for. Okay, you purchase the inventory for 4,800 and then you sell it for 7,600. And so cost of sale is debited and inventory is credited. So inventory goes down. Freight out, once again, it depends on whether or not it is the buyer that pays the freight cost or it is the seller that buys the freight cost. In this case, we have the seller. It could also be the buyer. Sales return on allowance, once the same similar things, but just reversed, and then inventory. Cash and a discount allowed. So discount allowed is an expense, and a discount receivable account receivable is here. Okay, so I going through the example is I think the best way for you to actually see and understand how when sellers have sales of inventory, they have two journals. They have two separate journals. We have accounts receivables and then we have cost of sales and inventory. So inventory goes down, but also inventory goes down when we do such a system. Okay. Let me also quickly mention the GST and how GST is recorded. So GST, once again, is general sales tax, is a flat of 10%. It is 10% across goods and services. Some notable exception includes rent doesn't have GST, gasoline doesn't have GST, and general supplies such as general or necessary living supplies such as groceries usually don't have GST. Besides that, most other things have GST in Australia. Um, as a business, you collect GST, but you also pay GST. What do I mean by this? When you purchase supplies, that usually has GST on it. When you sell your goods, usually at a higher cost than what you purchase it for, you also have GST of 10% on it. When you purchase GST, you could claim a deduction out of GST for the GST that you are collecting. When you sell something for $110, you only get $100. Yes, you get the $10, but that $10 does not belong to you. That $10 belongs to the government. So it is in a separate account for than your accounts receivable or than your revenue, because the GST is only you are acting as an agent for the government to collect the GST, but then at the end of the period, it could either be annually or I think quarterly. You're going to have to give this GST back to the government because it's a general sales tax. So what we see right here is 25th of July, a retailer purchases a table from manufacturer of 440 GST inclusive, which means that this is GST paid. On 30th of July, a retailer sells the table for cash of 550 GST inclusive. So this is GST collected. You collect 50 in GST right here. And 5th of August, you remit GST to the taxation authority. So this is how you record it. So 25th of July, you bought your inventory of 400, but there is GST paid of 40. So this is a cash at bank of 440. Cost of sales of 400, and then this once again, under a perpetual inventory system, you have to do 2 entries. Okay, so there we go. So that's just something to keep in mind. Now there are 2 ways you could record GST. There is the GST paid and GST collected, where you actually separate these 2 into different accounts when you do the journal entries, versus sorry, I'm getting a text right here, ignored, versus there are systems where you have just a GST clearing account rather than having 2 separate accounts for that. Okay. So from our textbook, we have a chapter 4 talking about inventories, merchandising operations, operating cycles, sales revenue, cost of sales, gross profit. Okay, so yeah, I do hope this review video helped you somewhat, and I'll see you guys next time in our next review video. Without further ado, take care and goodbye.